With world-class expertise and local insight, Dexus creates value, not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Good to have you with us as we round out, well, not just Friday of course, but the week. Let's take a look at what's happened on the market, making a bit of a comeback after midday, but not enough to actually take us into the green. So it looks like we're going to finish off around 0.25% for the session. In fact, the bank's proving to be the biggest drag on the local market. That was in the absence, of course, of the lead-in from Wall Street, given they did have that holiday overnight, but investors also remaining on edge as the conflict between Iran and Israel continues to play out, with the White House saying there's substantial chance of negotiations, but President Trump yet to decide whether the US will join in Israel's bombing of the Islamic Republic. He's saying he's giving it a time frame of 2 weeks, adding to that uncertainty. As a result, we did see actually oil drop around 2% as that 2-week deadline took some immediate pressure off the commodity markets. Spot gold also easing as well. So getting to the themes of the day, Trump timing, it's all very much based on whether the US does get involved. Obviously that would significantly escalate the situation and bring into focus again whether perhaps the outcome is for regime change in Iran. Friday fizzle, that's where the market has finished up. As I mentioned, they're off around 0.25% or so. And better bids. Look, this is all more action in the M&A space. So I'll get to that in just a moment. It's Better's bid for PointsBet. Just a bit of news that's just come out on that, in fact. I'll get to that in a moment. Let's just take a look at the sectors that have moved today. I was mentioning the banks did prove to be the biggest drag. As you can see, ANZ off some 2.5%. Commonwealth Bank, probably the best of the bunch there, but still finishing in the red and off its record highs. Doesn't that sound familiar that it's hit again this week? Elsewhere, another drag being the supermarkets, with Coles falling almost 2%. And on the consumer discretionary front, that was mostly negative as well, with Wesfarmers and Myer off around 2%. And the uranium miners, in fact, that's the uranium miners, there we go, there's the chart. Boss Energy tumbling some 3%. Look, obviously they've climbed significantly over, since this crisis began a week ago in the Middle East. And the energy sector as a whole, obviously, railing, and the uranium miners being the best of those. So maybe some profit taking there, although DPLO is finishing in the green. Let's get across the top stories. Treasury One Estates will hold an exceptional investor update next Tuesday amidst trading condition concerns. Lendlease, it's completed the sale of its Capella Capital infrastructure financing business to a Japanese firm for $235 million. So both those stocks ending higher. And former Virgin Australia boss Paul Scurrah will join the Web Travel Group. Fletcher Building will recognise a loss on claims receivable of some 16.5 million Kiwi dollars after reaching a settlement with the New Zealand Transport Agency. And Betr making an off-market offer of 3.81 shares for each PointsBet share, equating to $1.22 PointsBet share. And just had some news, in fact, PointsBet saying the offer materially below its $1.20 in cash per PointsBet share being offered by rival Mixi. So that still to play out, that bid for PointsBet. Both those stocks were in a trading halt. All right, now let's get to our stock of the day. We had the small cap special on today, and our experts Luke Winchester from Meriwether Capital and Dean Fergie from Cyanov Asset Management turned their attention to our stock of the day, which was AML3D.
There's a real product here. They're getting some real sales. Still very much in that early stage, right? Only preliminary sort of contracts. They're rolling them out to customers, but they're getting cash in the door. That's a good thing, and scaling up production to sort of meet the anticipated future sales they hope to get. They've just raised a big chunk of capital, $30 million a few months ago, so that balance sheet's pretty de-risked from that point of view. And now I think it's really about execution for these guys as this announcement sort of ties into opening the manufacturing facility.
So I think this thematic there is really, really strong, that you could end up with a tenfold increase into the amount of Archemy wire additive machines that AML3 are providing to the US government for being a product in that submarines that's verifiably behind schedule. So I'm kind of be really surprised if this thing's not pushing a lot higher in the near term when investors realise the really strong thematics behind the business. So, obviously I'm talking my own book, but definitely a buy on AML3D.
All right, let's wrap up the week. Joining us is Shane Oliver. He, of course, is the Chief Economist and Head of Investment Strategy at AMP. Shane, welcome back. Good to see you. All right, now it looks as though on the local market we're going to finish off about 0.5% for the week. It is the focus of clearly on that geopolitical concerns with Iran and Israel still going at it after a week. But I guess, moreover, we're looking ahead as to whether the US is going to get involved. And Donald Trump's given himself 2 weeks.
That's right. And that just adds to the uncertainty in some ways. On the one hand, you could argue it's a good sign that at least he's thinking about things. He's not rushing into it. And this situation does come with a lot of risk that US involvement could escalate the situation. But by the same token, we might have to wait 2 weeks to find out. And historically, Donald Trump does have a habit of saying he'll do something in 2 weeks and then the deadline comes and goes. So we could be in for a bit of uncertainty here. Obviously, Iran and Israel will continue to fight each other through that period. Maybe the US is just waiting for Iran to decide what it wants to do, wear it down, so to speak. Alternative, which may be a good thing. Alternatively, they could just be waiting to prepare and get their act together in terms of being able to optimally strike Iran. So it does add to uncertainty. It's going to keep investors on tenterhooks. You've now got two situations here. We've got the tariff deadlines for July the 9th, which is 3 weeks away, 3 or 4 weeks away, or 3 weeks away. And then you've got the situation in the Middle East. So it's going to be a bit of an uncertain period for investors. At the moment, I think markets are just treading water. We saw the initial reaction last week. The share markets come down a little bit, but in the great scheme of things, it's only a little bit of a flick off the top. Bit worse for Europe, but in terms of global shares, US shares and Australian shares, we're only down around 1% or a bit less in Australia's case from the highs. So it's not a huge impact. Past geopolitical events tend to see something like a 6 to 8% impact on average, with a big range around that. So at present, I think markets are just in wait and see mode, a bit like the Fed to some degree.
Yeah, indeed, of course. Having heard from them this week, Shane, we have seen obviously oil and gold rallying since the beginning of this conflict. Today, though, both those commodities coming off. I'm just wondering whether traders are perhaps willing to bet on the Tarco trade, that perhaps Trump will chicken out and not get the US involved.
Well, that could well happen. Maybe that is what's happening here. The oil market doesn't seem to be as focused on Tarco. It's actually gone up a little bit more than where it was this time on Friday. I think West Texas futures were around 75, 76, whereas on Friday they ended around 73. So there's been a bit more upside there. But you can see from that chart there, whether you look at it in real and nominal terms, oil prices haven't had a big movement. They're still on average below the levels of last year. So in the great scheme of things, it's not that big an impact. And maybe investors are saying, well, Trump will chicken out here. But maybe also investors are saying, well, we've seen this movie before. There's been so many conflicts in the Middle East. They don't all cause surges in oil prices. If you look at them specifically, you can see the big ones in the 70s there, 73 and 79, a fourfold and threefold increase in oil prices. The Gulf War had a big impact. The second Gulf War almost had a bit of an impact in anticipation, but almost from the get-go of the US getting involved in Iraq in 2003, the share markets rallied. So maybe investors are thinking, well, whichever way we go, it'll turn out okay. But I think it is early days yet in relation to all of this, and the risk this time around is somewhat greater than it has been in recent times anyway, simply because Israel is now going after Iran's nuclear capabilities. It sees it as essential to get rid of them. Iran obviously wants to hang on to them, and that's obviously creating a bigger, more difficult situation than we saw, say, last year.
Difficult situation for central banks at the moment, just knowing which way to go. As you said, Shane, we did hear from the Fed this week. They released their dot plots, 2 more cuts priced in. Perception perhaps they're slightly more hawkish than anticipated, particularly when we heard from Jerome Powell. Did you also get the sense that their outlook is somewhat stagflationary?
Oh, a little bit. There was a bit of upwards revision to their inflation forecasts and their unemployment forecasts. So in that sense, it wasn't so good. I guess the bright side was that they're still looking at 2 cuts this year. So that chart there shows the so-called Fed dot plot, and that is the expectations of all Fed members or Fed officials, and they're still looking at 2 cuts from the current level of 4.25 to 4.5. So no change from the situation from the dot plots in March. The disappointment, though, is that if you look at the green line there, their current dot plot sees less cuts or higher interest rates through the next couple of years than they previously saw. They're still concerned about the impact of tariffs, and they still want to see the impact of all of that. And they kind of think, well, the US economy is still okay, so there's no rush to cut interest rates just yet. So it is a very difficult situation. It is interesting, you've got Donald Trump on the sidelines. A week ago, he said they should cut by 1 point, which is his terminology for a 1% or 100 basis point cut in rates. This week, he's talking about a 2-point or 2.5 point cut. So he's piling the pressure on the Fed, saying that he could do a better job, that maybe he should transfer himself to the Fed and take over the Fed. I think he'd get it wrong. My concern would be that if you do cut rates to 2.5%, which would be a halving from current levels, you'd actually push up inflation expectations, and therefore the US government would actually be paying more in interest payments than what he's claiming. So it's a very difficult situation, I think, for the Fed. On the one hand, balancing all these things that are going on, the tariffs, the Middle East situation, which could push up oil and petrol prices in the US, there's still low inflation, still low unemployment, and you've got Trump sniping on the sidelines. So they are in a very difficult situation. I think they just stay and wait and hold for a few more months. They probably will cut, though, I think starting in September, and then you get 1 more cut by year end. Bottom line is that if you look at the run of economic data recently out of the US, for things like retail sales, industrial production, housing starts, housing permits, home builder conditions, they're all soft. They're all soft. And that's telling us the US economy is still slowing down, even though the unemployment rate is still low.
Yeah, meanwhile, Jerome Powell, has 11 months left in his term. He's going to have to put up with this character assassination attempt, isn't he, from Donald Trump for the duration of that time while the jockeying continues as to who is likely to replace him. Shane, let's talk about how the Aussie economy is tracking, perhaps in comparison to what we're seeing in the US as well. And of course, we did get that key read on jobs this week as well.
We certainly did. It was a nice, quiet week on the data front in Australia. There's enough going on internationally to concern economists and investors generally. But in Australia, we did get some good news on unemployment, still very low. Look, these numbers are a bit of a lottery, what you get. I'm always surprised when I go and look at the screen when the numbers come out. A month or so ago, we got, 89,000, and it got revised down to about 88,000 new jobs. Unemployment 4.1%. This time we get a fall of 2,500, but unemployment still at 4.1%. So maybe the key is to focus on the unemployment rate. It's still low in the great scheme of things, a little bit up from the lows around 3.5% a year or two ago. But you can see from that chart there that in the historical context of the last 30 or 40 years, unemployment and underemployment, which you put together and you get underutilization, which is the blue line, they're still pretty low. And I guess if you're a hawkish economist or investor, you'd be saying, well, that's too low for the RBA to be cutting rates. It means wages are going to pick up. The dovish view is, well, the history is not necessarily the best guide. The reality is that wages growth has been slowing down despite still low unemployment. And the Reserve Bank seems open to the view that their assessments regarding where full employment at or the full employment level of unemployment may be lower than what they've been previously thinking. In other words, the NAIRU, if you're into those things, is lower than they've been thinking, which I think, or when you put all that together and then you allow for ongoing indicators from SEEK and others who provide job advertisement data, the SEEK data is actually a little bit worrying in the sense that you've seen a strong rise in the number of applicants per SEEK job. In fact, the ratio of the two has gone above levels seen through the pandemic in terms of the number of applicants per job. That's a sign the labour market is softening. You've also got some signs there that the public sector employment growth may be starting to slow down. So that's all a bit of a warning that the labour market, I think, yes, it's still fairly strong now, but it could be starting to slow. When you put that together with softer than expected GDP growth, the threat to the outlook from Trump's tariffs and now the situation in the Middle East and falling inflation, we get an update on that in the week ahead. That, to me, all suggests the Reserve Bank should still be cutting rates. And we do think they will cut at the July meeting, in early July. And the money market, I think, is right to put about an 80% probability on that occurring.
Yep, couple of weeks' time, we will get right across that. Shane, just before you go, so given all of what we've just discussed, are you still feeling perhaps we're due for some sort of pullback, particularly in equity markets at the moment?
I think that's where all the risks go. We've seen great rallies. Markets got up to around record highs. In fact, in Australia, we did get to a record high a couple of weeks back, or last week, in fact. Now, you've got all these issues on the horizon or floating around, and they, to me, suggest that we could see a bit of a pullback. Tariffs, Middle East, the debt situation in the US. We've also got a very low equity risk premium. So the PEs are quite high, which means the earnings yield on shares in the US and to a lesser degree in Australia is actually quite low. When you've got bond yields around these sorts of levels, it means that shares aren't offering a great risk premium over bonds. So all of those things leave the markets a little bit vulnerable. July is often an okay month seasonally for shares, but then we know August and September are often a bit rougher. Now, I reckon by the end of the year, by the December quarter, things should start to look a little bit better. The Middle East will have settled down, I think, by then, almost certainly will have settled down by then. Trump will have pivoted to more favourable economic policies. Central banks will still be cutting and the Fed would have joined in. And that, I think, will enable shares to recover into year end and sort of see okay returns for the year. But I think over the next 3 months, you're probably going to see a bit of volatility with that risk of another pullback.
Shane, terrific as always to cover off what you're seeing at the end of the week. Thanks for joining us on AMP. Have a great weekend.
Thanks, Andrew. Take care.
All right, let's reiterate where we're finishing then. And these are the leaders on this Friday. Zip is up around 6% along with NRW Holdings, Lifestyle, Brambles, Data 3 all doing well today. On the negative side, checking in on those losers. Look, Clarity Pharmaceuticals has been on a tear of late. It's actually come off 7%, maybe a bit of profit taking going on there as well. Mineral Resources, there is some weakness more broadly in the iron ore sector, given some weak steel production data out of China this week. Also, that's hit lithium as well. Some downgrades there for the lithium price hitting PLS, and Luca also coming off. In the small caps, EZZ Life up some 16%. Saturn Metals also among the picks there. And on the negative side, 3P Learning tumbling 17%, along with Northern Minerals also on that list. So tonight, as I mentioned there before, the ECB releasing its economic bulletin, and consumer confidence also read out of the EU with the Philly Fed Manufacturing Index as the US market is back online after last night's holiday. And in the week ahead, let's just check in. We got some very brief earnings results, MTS there. Virgin also due back. It's a landing back on the ASX. Collins Foods earnings there. Also, as we mentioned a little earlier, Treasury Wine has an investor briefing. We do get a read on Aussie inflation for last month on Wednesday, and also trade balance out of the US on Thursday. So let's recap where we finished. Down around 0.25% for the week. It looks like we're going to finish down close to 0.5%. Thanks so much for watching and listening. We'll do it all again next week.